18's Mumbai Newsroom. I'm Sonal Bhutra and with me is Pavitra Parekh. As always, you're watching Mutual Fund Corner. Well, we keep discussing a lot about mutual funds and long-term investing, but recently many banks, they've not revised savings account rates. This is despite an increase in the repo rate by the RBI. So is it a good time for an investor to look at short-term funds like liquid funds or money market funds? That is something we are going to be discussing today, Pavitra.
Oh, absolutely. It's all important. And we have a guest in the studio. So Rahul, thanks a lot for coming by. Rahul Jain is president and head at Nuvama Wealth. So Rahul, like Sonal
Thanks for having me in the show.
It's lovely. We know that you made the trip all the way from Andheri, so we really do appreciate it. But like Sonal was pointing out, savings bank account rates have not gone up despite the rise in repo rates. What should an investor do at this point? Should they stay put? Do you think they should explore other avenues at a time like this?
So I think that's one of the things which has not happened. If you see the RBI has increased the repo rate from 4 to 6.5 and there's been 6 consecutive rate hikes.
Yeah.
But if you look at bank saving rates, they are hovering between 2.75 to 3.5 and there are some outliers to it. So effectively, yes, that's not moved the way repo rates have moved. But from client perspective, if you look at it, I think there are avenues like liquid funds, money market funds, where the rates have gone up. So they have gone up from around 3 to 6.5 or from money market for 4 to 7. So having or moving your money from a saving bank account to I would say a liquid fund in this type of times makes a lot of sense. And I think that can be a good thing for an investor to do at that point in time, because end of the day, whatever you end up making more on your investments, it's like extra saving only.
Yeah.
And that is how your wealth gets created over a period of time.
Oh yes, it does make sense. So you mentioned liquid funds, money market funds. Let's discuss that separately as well. And starting with liquid funds, what makes a case point to invest here? Apart from some of the things that investors should know, what are they exactly? And why possibly should an investor look at it? What are the benefits?
So I think one of the very important case point is that your savings rate is around 3 to 3.5 for larger banks, correct?
Right.
On the other hand, your liquid funds is around 6.5 right now. So there is a lot of difference between the both in terms of the returns what you make. That is one. That is the biggest use case because your returns are far higher. Liquid funds are generally a short-term funds which generally up to maturity 91 days. So effectively anyone who is planning to invest for 90 days, because a lot of people put money in saving account because they want a safe haven or something, thinking that whenever I need, I will take out the money, because you have ATM cards, you want to swipe up the cards, you can withdraw money
easily accessible.
Yeah. So that is what the reason is. But moving to liquid funds make it easier, and I think 90 days makes it very short term. So generally these liquid funds gets invested into commercial paper, G-Sec, treasury bonds up to 91 days. And that is where the whole investment happens. I think from since these are very short tenure funds, very short term in terms of duration, and largely are government treasuries, so the credit risk is also very, very minimal. So effectively, I think it's a good alternative, I would say, to a savings bank account money which is kept by the clients.
Yeah, money is still easily available to you in that case.
That's true.
Yeah. But Rahul, since we're talking about liquid funds, another category which is pretty similar in the fact that it matures in 1 year at least is a money market fund. Is that a good alternative as well for someone who's looking to move out?
So if you see liquid fund and money markets are very similar. The only difference is that money markets is for a 12-month duration. On the other hand, liquid fund, as what I spoke, is around 90 days. That is the larger difference. But the type of investments, the quality of papers, like there also it is treasury bonds, government treasury, G-Sec papers, commercial papers, which gets invested there also. So effectively, if you see, the only difference is the duration. And anyone who's planning to invest or wants to park their money from not 90 days but for a year time, 7-8 months, I think then money market makes more sense. Since it's longer in duration, your yields or your returns on money markets are tad better than the liquid funds. And that is how you should look at it.
Okay, so tenure and the returns is the difference between the two. But do you think, you're talking about all the benefits that these short-term funds really provide, is it really easy for people to move from, say, savings banks to these fund investments? Because it does take a switch cost as well, right? So do you think this is something people should actively consider and they will do it?
So I would say there are three three things which generally plays in people's mind. One is that there is a lot of convenience what a saving bank account gives you. Like you can withdraw money at any point of time, correct? That is one. Second is that also investing into liquid funds or money market funds and then final redemption also has effort. You have to put in, go into online platform, buy it out and then finally redeem. So it is not that convenient. Apart from that, there is also a tax exemption or for saving bank account interest, which is ATTT A and B, 10,000 for individuals and 50,000 for senior citizens. So these are two things, or I would say three things, which creates a lot of, I would say, people are not very comfortable. And also I think the larger one, which also is over and above this, is that these funds, like liquid funds or money market funds, the awareness in the retail market segment is very, very low. So generally people are not aware, and also since it requires effort, people are also thinking, let's leave it only. That's how the thinking is all around. But we always keep telling our clients that anything which is yielding you lower returns, and if you can switch them to a better returns, that is how your wealth gets created over a period of time.
This is not a place you want to be lazy, right?
Yeah, exactly.
But I also feel like there isn't that much knowledge about this, right? Just about the fact that you can move to a liquid fund or a money market fund and increase your corpus by that much. You were talking about the tax implications. If you could just take us through that a little bit more, what do they look like really here?
So if you look at a saving bank account, the interest what you earn from there, I think it gets taxed at marginal rate of your taxation. But there is one benefit which is there, that for individual investors you get 10,000 rupees exemption. And for senior citizen it is still 50,000 rupees. On the other hand, if you look at both liquid funds and money market funds, your taxation is at marginal rate. There is an indexation benefit after 36 months where you get a 20% tax, and there's an indexation benefit. But generally, since you're investing for a very short duration through these two funds, 90 days and a year, then it will get taxed at marginal rate only. So if you see, both are very equal in terms of taxation, apart from that one exception, what savings bank account interest rate gets of 10,000, 50,000 for normal investor and the senior citizen. That's the only difference.
Okay. So does that make a case, if we've spoken about the benefits as well, of course, right? And you also said that while people are not very aware of the short-term market, they can still go ahead with it, especially the retail investors. What do you think is the case for not investing, or some of the disadvantages that an investor should keep in mind? You mentioned them, of course, in terms of tax and the period as well. Is there anything else an investor should keep in mind?
So there are two things which investors should take in mind, is that when I was speaking about that these funds or liquid funds or money market funds invest in government treasuries, GSECs, commercial papers. So there are also private company papers which are there, very high quality, but there is a certain amount of credit risk. That is one. Secondly, generally money market funds or liquid funds are not very sensitive to interest rate movements. Not very sensitive, but if you have an adverse movement of a good amount, then there can be adverse impact. So these two things they should keep in mind while investing into liquid fund and money market. But generally I would say that they are fairly safe. They makes a very good sense of switching your money from a saving bank account which is earning you 2.7 to 3% and move to 6%. And that's a big arbitrage available. If you, for example, if you have 10 lakh rupees which is lying in saving bank account just like that, and if you're able to switch, you can make a 30,000 rupees difference over a period of time. And it's not a small amount for a retail investor. Effectively also, I've seen that a lot of investors, clients just don't bother about it.
Right, exactly.
As you said.
They're not aware about it. You see that small interest credit every quarter and you're like, okay, that's fine.
Or you feel like I'll do it next time, you know?
So that inertia of not moving that money out is always playing in mind. But we always keep telling people that at least you should not be lazy with the money.
Oh, absolutely. And I hope this show might, push someone to maybe make that switch. But Rahul, I request you to stay on. We are going to take a short break. We'll be back in just a minute. We have lots more questions. Hey guys, welcome back. You're still tuned into Mutual Fund Corner here on CNBC TV 18, and we're talking about the alternatives that you can pick to a savings bank account. We have Rahul Jain of Nuvama with us. Rahul, we have spoken about how short-term funds can prove to be a good alternative, but if not short-term funds, take us through some other alternatives as well.
So one of the things, since we spoke about that people are generally lazy, I think one of the things which is commonly available as a product with bank is that there's a swipe in FD concept also. So you can tell your bank that above any 10,000 rupees balance, 5,000 rupees balance, whatever is excess, please swipe it off as a FD. And whenever you need it, that gets automatically broken. So that can also be a good alternative for people who generally are lazy and who does not want to take the effort of moving their money from saving bank account to liquid money market. And I think that is one of the ways which the money can go into a higher returns with no extra effort, effectively, and you anyways have money in your bank account.
You're talking about people being lazy, right? We have to make our money work, and that's exactly what we are trying to do with this show as well. Rahul, we're talking about short-term funds, but do you think at this point in time, when we are in a rising rate scenario, we are talking about it maybe peaking out as well, is it a time to look at debt funds and also target maturity funds? Because I was reading a report which said that retail investors are still not looking at these funds, so to say, just 1% contribution here. What do you make of this entire space?
So I think for debt funds, since you're asking me, I certainly feel that you should wait because RBI has been consecutively raising rates. Debt funds generally do well when rates are going down effectively, and we are still not very sure when the downward cycle of rates will start happening because we feel, or large part of the people feel, that RBI will still look at more data on inflation before deciding on the trajectory of the rates. So anyone who is planning to invest in debt mutual funds has to be wary of the fact that there is a risk pertaining to interest rates right now, because it's a high interest rate going up regime right now, and that he should be careful around. I think to mitigate that risk only, there's these target maturity funds which you spoke about, which are like that if you stay with that fund up to a certain period of time, you get a fixed rate. So there is no volatility on the return side. You're very certain that 7%, you will get 7% if you if you stay for 5 years, 6 years, 7 years. And generally the duration of target maturity funds are 5 to 10 years. But now certain asset management companies have also launched 1 to 3 years as well. So the best part of target maturity funds is that your returns are certain, and that is something which the investors or retail investors are very particular about. So they don't want any volatility in debt investments, fixed income investment. They want certainty is very important, and that's why I think in that case target maturity funds fare very well.
Okay, so that's on target maturity funds. What are you making of the cycle that we are in? We were talking about it as well. Very choppy outlook that we have, considering the geopolitical worries, or what's happening globally as well. Is it a good time to look at any sector, so to say? If you can talk about it as well, sectoral funds. What makes sense for an investor right now? Should they just stay put, raise cash levels? What's your idea generally?
So I would say right now be in defensives, and whether it is equity, debt, composition, we always believe that asset allocation is the best way of achieving your wealth. It's a combination of debt, equity and gold, and you should continue with that. And right now I think you should be conservative in your approach because markets seem to be volatile. I think over the next 3 to 6 months, there will be good time to start looking at equity back because you'll start finding a lot of value in the same. And from debt point of view, I think it's a combination of short-term, long-term, as we spoke, where the short-term works for as emergency corpus, your lazy money, as we spoke about, and the long-term is where you want to invest for fixed income from long-term point of view. And you can use a combination of target maturity funds, NCDs, fixed deposits. And for short term, you can use either liquid funds, money markets, or you can use, as what I say, FD swiping, which is a good concept which people can use it. And that is how I think people should work building their portfolios. But keeping asset allocation in mind is very important, very critical, which very investor should look at it.
Oh, absolutely. That advice is well taken. And I think we've done a complete deep dive into the kind of alternatives that you can have to a savings bank account, and of course also in the market, like you mentioned. Rahul, thank you very much. It's been a pleasure to have you in the studio.
Thanks for having me in the show.
Thank you. Yes, looking forward to more conversations for sure. And for everyone who watched us, please take a look at your savings bank account, the rate it is providing, and if you at all can make a switch and that's beneficial for you as well. Thank you so much for joining us today on the show, but do remember to email us all your queries and we'll address them with our experts. Leaving you with some more market opinion from Dheeraj Agrawal, who is the co-head of equities of Ambit Capital. Stay tuned for Closing Bell to take you through the last hour of trade. Thanks a lot for joining us.
The market's likely to be range bound for